Welcome to episode 4 of Tomiczek Financial's podcast series, and today we're talking about everyone's favorite topic, investing. So, we're new to Canada, we're new to investing. We want to know why we should be investing and when should we start.
You should have started yesterday, right? This is a topic that I get a great deal. A lot of students will ask me, and also a lot of clients and potential clients. So number one, what I would say, before you start even thinking of investing,
right,
you want to set an emergency fund, right? If there's one thing COVID has taught us is that expect the unexpected.
That's right.
So at the very least, I know financial planners and the books will say 3 to 6 months worth of income or expenses. I would even maybe go a bit more to 6 to 12 months of that you put aside just in case something happens. But as being new to Canada, we may not have that kind of liquid asset right away. So at the very least, I would say, put away 1 month's worth of rent just in case something bad happens. And then once you've done that, then we could look at starting to invest.
So you say put away your emergency fund, have that secured. So how much should I have to start investing?
You know what? In Canada, with various tools such as segregated funds, mutual funds, and even stocks, with as little as $25, $50 a month or a week or bi-weekly, you could start investing and be fully diversified. So money is really shouldn't be any obstacle.
Right. So, people often will have a reservation whether they should get into investing or not. What do you say to those people? Okay, I've heard about it. I want to start thinking about it. I think I have some money. What would you say to them that would have that fear of investing?
Well, first, that fear is real.
Yeah.
Right. So definitely acknowledge it. So one of the things that I want people to, before we start investing, I want to get to know them. I want to know your client.
Right.
So that way it will appease not only the client, but also appease me in terms of what level of risk. So I'm going to ask them a whole bunch of questions about their personal situation. Are they married? Are they single? Do they have kids? Your income, your goal. What is that money for? Right? That will be important. Is it for your education? Is it to buy your first home? Then your risk tolerance. Right? Are you low, medium, or high risk? When the markets are going up, everybody's high risk, right? But it's really what I'm going to focus on is when the markets are down. What is kind of your risk level? And then lastly, we've talked about investment objectives, your time horizon. How long do we have? Right. If we need the money by next year, we're not taking any risk.
Right.
But if we've got a longer period of time, so let's say it's for retirement, your children's education, then we could weather the bumps of the market and we could take on a bit more risk. Once I have that picture of Josh, who he is as an investor, then I could create a portfolio that will, make sure that his hair doesn't go any grayer than what it is right now with the ups and downs in the market.
Right. So I, being a beginner in investor, you've understood my profile. Let's just say that I am a low risk. I want to preserve my income because I want to have my money so I can pay my tuition next semester. What would you advise me to invest in as compared to someone who I want to buy a car next year, and then someone who says in 10 years I want to have a down payment on my house?
No, very good. So I want your first experience to be a positive one. Right. So the first thing I would do, given that you have low risk and you need the money for next year, I would give you what is known as a GIC, a guaranteed investment certificate. That way, you probably make about 4.5% on the GIC, so that next year when you need the money, it would have grown a moderate amount, 4 to 5%. And then after, kind of dip your toes a bit more into that cold water. Have a combination of safe and secured investment and investments that will potentially grow at a higher rate than the 4 to 5% that the GIC provides. But it's kind of gradual.
Right.
I'm going to take you along that journey.
Right. So you're protecting my principal investment, but also there's an opportunity for growth to happen.
Definitely.
So let's say somebody now comes to you and they say, hey, Pierre, I think I want to invest in something that is going to give me long-term growth. What would you say to them?
Well, first I want to know, yeah, that's great. But going back to who you are, what type of investor are you? So a lot of people are looking for that perfect investment. So everybody is looking for that perfect investment, right? Low risk and high return, right? Well, that really doesn't exist. So if you're willing and able to take the various risks that comes with this type of growth investor, I would look for dividend paying stocks or investments. Especially given the amount of money that we have, I would go into, let's say, a segregated fund or a mutual fund that invest in Canadian dividends and maybe even U.S. or international dividends. So one of the good things about dividend funds is the fact that dividends are only paid when a company is profitable.
Right.
So you're investing in profitable, generally speaking, blue chip companies such as the banks and energy companies. And a benefit of that is as they're paying those dividends typically quarterly, instead of putting the money in your pocket, that additional dividend, you get to reinvest and buy additional shares or units in that mutual fund. So you may only have $25 on a weekly or bi-weekly basis to invest, but as the fund is doing well, the extra money is reinvested. So again, you get that compounded growth, which has been known as to be the eighth wonder of the world, right?
Yeah, we mentioned that several times, and I think it's important because, if you start now, as you said, I should have started yesterday.
That is correct.
And I haven't, so I need to start.
Yeah.
And I know the team at Tomiczek, they're going to help me out, and they're going to ensure that I have the adequate diversification in my portfolio, as we would often say. And speaking of diversification, as we age, unfortunately we age, our investment objectives will change. Can you shed light on that? Like, let's say at different stages, how that changes?
Yeah, there's such thing called as a life cycle analysis. But again, I got to know my client, right? So you don't want to be generic in your approach, but you do have that in the back of your mind that people go through different stages. So therefore, by knowing my client, I have a better understanding of who that individual is, not the average Canadian. I don't care about the average Canadian. I care about Josh as to who he is.
Right.
But nevertheless, when we start in the early years, so let's say in our 20s, we've got this long window, right, that we can invest, right? So we tend to be more growth oriented. We could take on a bit of risk, right? And then we get to our 30s, right? Our early earning years, right? We get to our 30s, mid 30s. This is a time that we probably have a family. We're married. Maybe 2.2 kids come into play, and now our perspective kind of changes. So yes, we still got time. We're still fairly young, so growth is still important, but tax minimization, right? That is also important. So maybe if we're going to invest at that stage, we're going to incorporate the TFSA, the RRSP, and maybe the FHSA that we've talked about before. And then we get to our, kind of our peak earning years, the 40s and 50s. This is when we make most of our money. So we've accumulated a lot of money. So now maybe growth is not as important. We probably want to make sure that that money that we've accumulated over our lifetime stays there for a long period of time. So safety might be important. So instead of being a bit more aggressive, our risk tends to go down as we age. And then once you get to my age, then maybe safety and income is probably more important. But having said that, again, we don't want to pigeonhole clients.
It really depends on the objective of the investor.
Exactly.
Right?
Exactly.
Because you might be your age, but you still might be looking for growth in, whatever it is, maybe 10-year growth very quickly turn around because you have something pending in 10 years. So it really depends on the investor, and I guess that's what Tomiczek Financial is. They try to understand the client and understand what is needed. Yes, there are generics that we can always go back to, but I guess we can always spend time personalizing it for that investor.
No, definitely. I mean, even myself, I kid in terms of old. I still got, God willing, a 30 or 40 year time horizon.
Yeah.
So I could still weather the storm. So my portfolio is still kind of growth oriented. But even for the beginner, one of the things I want to make sure is that your first foray into investing is not a negative one. So we've got some strategies within our team whereby we will guarantee, if you're willing to invest for, let's say, a 4 or 5 year period, you could take on risk, but we'll still guarantee a minimum return, whereby at the very least you would have your original principal back.
Right.
But if you're dedicated to stay for 3 to 5 years, we can make that guarantee.
And, you're talking about all of these investment strategies that we should undertake and how we should do it and at what stage of our lives we should do it. But what do you say to those, persons who want to invest to avoid, what mistakes they should avoid when they're investing?
Speculating. Because a lot of people think they're investing. Investing is kind of a strategy. It's kind of a plan, right? Speculating is, as you know, Tesla, right? Putting all our money into Tesla or Bitcoin. Hey, we may be right? We may be right, but we've got to look in the long term. So try to avoid speculating. There's a theory that goes, it's known as the odd lot theory. And this is what the big guys do, the opposite of the little guys, the odd lotters, right? So when the little guys are buying, the big guys are selling because they're speculating. And when the little guys are selling, the big guys are buying.
And I could remember the story about a couple of years ago where the little guys knew that it was happening, and it happened that market turned around that day. That was it was tremendous, but again, that doesn't happen often.
That's right.
And therefore, I guess it's very, very important to understand to not speculate, because you don't know, and it's really difficult to predict. And it's always you can always say, I should have done that.
That's right.
But as you said, the best time to get into the market is yesterday, and you start with a strategy, and that's where Tomiczek Financial come in. They can help you to devise that strategy in order to make your investing goals a priority.
Exactly, and you need the time.
Yeah.
Right. You need the time to weather the storm, and
That's
if you're dedicated enough to give about 3 to 5 years to that strategy, you'll see that the markets, they go up and down. But generally speaking, if you take a 10-year average, a rolling 10-year average, the markets tend to be 90% positive.
So I'm an investor, and I know of all of these things now. I might be a bit reserved again in terms of investing, but what can Tomiczek Financial do for me in terms of, I know I'm going to earn dividends, or I'm going to earn whatever income I'm going to earn, might be interest income. How do I minimize, and I think we spoke about this in the past, but how do I minimize my tax implications when I'm investing?
Number one, everyone should have a TFSA, right? Everyone, young and old, right? Well, not too young, because minimum age is 18.
Right.
So even with the emergency fund, that 1 month's rent that I said at the basic, at the very, you should put that in a TFSA. One of the things that people may not be aware, you could have as many TFSAs as you want at many institutions, as long as you don't go over your limit. So let's say the limit is $7,000 this year. You could have 7 TFSAs earmarked for 7 different goals. One for emergency, one for your to go towards the purchase of a house, one towards the purchase of your first car, so be it. And then the different TFSAs, we could have different investment.
Right.
So the emergency, very conservative, right? If it's more long-term in terms of retirement, we could take on a bit more risk. So again, it's to get to know Josh, to look at you holistically and kind of create a plan that will minimize your overall risk and ensure that you meet all of your various goals.
So to summarize all that we've said today, you said we should start investing yesterday and we should have that plan. So what is your advice to close it out and how maybe Tomiczek Financials can help us to achieve our investment goals?
Yeah, so maybe give us a call, give one of my team members a call, or call me, or contact us through our YouTube channel, and we'll get to know you, get to understand your goals, your time horizon, risk tolerance, and then we'll open an appropriate investment product for you within a TFSA, could also be within an RRSP, and if you're looking towards buying your first home, then maybe the first home savings account will probably be applicable to you. So get in contact so we get to know you, and then we could devise an appropriate plan for it.
So get that personalized approach to investing from Tomiczek Financials.
That is correct.
All right. Thank you so much, Pierre, for stopping by as always. And, we love to hear what you have to say, and the advice is invaluable.
Thank you, Josh. Have a great day.
All right. That has brought us to the end of episode 4 on investing. And I hope you're enjoying this series. We will have more for you. You can contact us right here at Tomiczek Financials. Subscribe, like our videos, share it on your platform so other people can benefit as well. Thank you for watching, and we'll catch you on the next one.